We believe the communication infrastructure sector is one of the more compelling valuation dislocations we're seeing in infrastructure today. These essential assets with long-term contracted cash flows are trading at valuations we haven't seen in years. Cell towers or towercos own the physical tower infrastructure that mobile operators rely on. Revenues are underpinned by long-term contracts, in some markets being up to 20 years, which gives very visible, recurring cash flows, and where adding new tenants to an existing tower has a low incremental cost. Combined with ongoing growth in data usage, this has historically been a very strong business model which continues to attract substantial private capital. However, listed valuations have weakened significantly. Rate volatility and more recent concerns about mobile operator consolidation have weighed heavily on sentiment. As you can see on the chart, tower companies have lagged global equities and global infrastructure by a wide margin. For us, this valuation reset is actually a key part of the opportunity. The sector now represents around 15% of our portfolio, and the relative value stands out when clearly compared to the valuation metrics and cash yields, with the multiples being paid by private buyers. Europe is where the dislocation is most pronounced. It's apparent that the consolidation risk is one key investor concern because fears around tower decommissioning are weighing on the market. But if regulators ultimately allow consolidation, we suggest it will also support the sector where historical operator combinations have included mandated infrastructure spending. Stronger operators then tend to invest more, which leads to network quality improvements and better activity for tower companies. So it cuts both ways in our view. Let me touch briefly on the individual European names in our portfolio. Starting with Cellnex, which looks highly contrarian, the shares are trading at their lowest valuation levels since IPO at around 13 times EV to EBITDA. This looks particularly dislocated when you compare it to the private market. Cellnex has sold assets itself, such as its Nordics and Irish assets at 23 and 24 times respectively. And over the next 5 years, cash returns to shareholders could be in excess of 50% of the current market cap. The other investment is Inwit, which shows the same kind of valuation gap. The stock is trading well below private market benchmarks, including at 26 times where a minority stake changed hands a few years ago, and around 18 times for its own shares where its largest private investor increased its position as recently as 2024. Today, Inwit shares are trading closer to only 14 times. Looking ahead, there are three things that should support these European investments. First, an acceleration in spending post-mobile operator merger integration in Spain and the UK reaching completion. Secondly, greater clarity around contract renewals in markets facing potential consolidation uncertainty. And third, we expect greater visibility around Cellnex's next phase of growth. The latter we think will become more apparent over the course of 2026. Before closing, a quick update on satellites. There is a lot of interest around low Earth orbital satellite constellations like Starlink, but satellites are not replacements for towers. They are complementary, helping to deliver connectivity in rural areas where towers are not economic. They do not provide the density, the capacity, or the economics needed in dense urban environments where the majority of the global population lives. Even Starlink's Elon Musk suggested that satellites are designed to be supplemental. We like tower assets because they are essential, they have long-term contracted revenues, and today they are trading at valuations that imply strong long-term compounding returns well above our cost of capital.